Hey, welcome to The Explainer. Today we are diving into a big one of the most fundamental tools in all of finance, the capital asset pricing model. You've probably heard it called CAPM.
All right, let's just jump right in. Every single investment has risk, right? I mean, it doesn't matter if you're buying one share of a company or pouring money into a giant fund. There's always risk. So the real question is, how do you put a price on it? How do you figure out the reward you should be getting for taking on that risk? That's the puzzle we're going to solve today.
And believe it or not, in the world of finance, the answer often comes down to a formula, a pretty powerful one, actually. And that's exactly where the capital asset pricing model comes in. It takes that big, kind of abstract question and turns it into something we can actually solve with an equation.
So what is this thing, really? At its core, CAPM is a formula that helps you estimate the expected return on an investment, given its specific risk. It's all about connecting the dots between how much risk you're taking on and what kind of reward you should demand for doing it.
And here it is. Yeah, I know. At first glance, it definitely looks like a bunch of alphabet soup, but stick with me here, I promise it's not as scary as it looks. Each one of those letters tells a story, and we're going to break it down, piece by piece. Okay, so let's decode this thing. Let's really get into the nuts and bolts of what makes this formula tick. First up, we've got RF. That stands for the risk-free rate. Seriously, think of this as the absolute baseline. It's the return you could get from a zero-risk investment, like a U.S. government bond. It's basically the pay you get just for letting someone borrow your money over time, even if there was no other risk involved at all. All right, next up is beta. This little Greek letter is maybe the most interesting part. You can think of it as a stock's personality. It measures how much a stock swings up and down, its volatility, compared to the entire market. It's all about that specific stock's character. So what do the numbers actually mean? Well, if a stock's beta is more than 1, it means it's jumpier, more volatile than the market as a whole. Its highs are higher and its lows are lower. But if its beta is less than 1, it's more stable, less volatile. And a beta of exactly 1, that means it pretty much moves in lockstep with the market. Simple as that. And finally, that chunk in the parentheses. That's called the market risk premium. Now, this is important. This part has nothing to do with our one specific stock. This is the extra bonus, the extra pay that investors demand just for being in the stock market at all, instead of playing it super safe with that government bond we talked about. Okay, theory time is over. We've got all the ingredients. Now let's put them all together and run some actual numbers to see this thing in action. So let's imagine a scenario. Let's say the risk-free rate is 4%, and we expect the total market to return, say, 10%. And the stock we're interested in, it's got a beta of 1.2, so a little more volatile than average. All we do now is plug them in. We take our 4%, or 0.04, add that to 1.2 times, the market return of 10% minus that risk-free rate of 4%. You run the math and boom, you get 11.2%. So what is that number? According to the model, that's the expected return you should demand from this investment. It's often called the cost of equity, and it's the bare minimum return you'd need to make it worth your while, covering you for both the time your money's tied up and the extra risk you're taking with this specific stock. Okay, but so what? We have a number, 11.2%. Who cares? Well, you should care. This is way more than just a number you get in a finance class. It's a genuinely critical piece of the puzzle for making huge, real-world financial decisions. This cost of equity we just calculated, it gets plugged into all sorts of other massive calculations. You need it for something called a discounted cash flow model, which is a popular way to value an entire company. It's a building block for calculating a firm's weighted average cost of capital. You'll hear that called WACC. Basically, this one little number helps investors and companies decide if a project or an investment is actually worth it. So if you boil it all down, that's the whole point. CAPM gives us a logical way to think about risk. It's a tool that tries to quantify that relationship between taking a risk and what you should expect to get paid for it. It's a baseline, a starting point for making smarter investment decisions. And that really brings us to a final, pretty deep thought.
CAPM is amazing for putting a price on a certain kind of risk, the risk that just comes with being in the market. But it also makes you wonder, right? If a formula can do that, what about all the risks it can't see? The totally unpredictable stuff, the company-specific scandals, the once-in-a-lifetime events that no model could ever predict. It really makes you think, what are the risks that will always be beyond the reach of a formula?